Hello, this is Ken Tomko with T2 Asset Management doing our monthly review of what's going on in the markets. As always, please don't use these videos for trading purposes. They're for information only. We start out here with the weekly chart of the S&P 500, which gives us about the last 6 years look at what's been going on. So you can see here in 22, we had a bear market there as interest rates started to rise. And now I've had a completely unexpected rally from a lot of people's point of view. The 23 was supposed to be a terrible year for the stock market, and it turned out to be anything but. It was up in the 24% range for the year. And we had a little sell off there towards the end, but then Santa Rally kicked off, and here we are, and we're actually looking at, as you see here, all-time highs in the S&P 500. I mean, we were really close to that, another 1.5% away from that. Had a little bounce back off of it last week, but everything looks like we're going up. So right now, the long-term situation in the stock market is up, and as you can see here, the trend line, all the moving averages, everything up, and we're looking like we're about to pop through into all-time highs for the S&P 500. We come down here to a daily chart, and this gives us the last couple of years trading. You see that in 22 we had the very choppy nature of the market, and for this year it's starting to, for 23 it started to smooth out a little more. We certainly got invested as the rally happened, took a little off during this period here where you can see it kind of came back through the summer and fall as it was retracing, but got everything fully back invested here and off to the moon. And it's been totally unexpected. And we keep hearing the news with everybody saying, oh, there's a recession, it's going to be terrible and all that. And that's kind of why we tend to pay attention to the markets themselves, because they're saying something different than what the people on TV are saying. And we put our money behind what the markets are telling us they're doing. And right now they're absolutely in rally mode. If we come over here to a 2 hour chart, and every one of these candlesticks here is 2 hours trading. So this gives us about the last 6 months of trading. You see, I highlight a little channel how we're moving along here. And it's just all systems go. From the start of November, we've had just a really, really strong rally here up into basically right under all-time highs and moving right along. So we've been fully invested in participating in that. Sure, I understand what people are talking about from an economic standpoint and such, but hasn't shown itself yet. And I find it more profitable to simply pay attention to what the markets are doing than what people are predicting. We look at some of the internal measures here. You see this top one. This is the percentage of the S&P 500 that's in an uptrend. During the early parts of this rally here, as you can see, it came off the floor in November and got up to 80%. 80%. That's not really that bad. Really strong rallies would see it a little higher, maybe 90%, but still, that's really good. Certainly has come off a little bit in recent days as this little sell-off happened, but nothing too alarming as of yet. This second one down, this is the advanced decline line on the S&P 500. And as you can see here, that is just still just going up and away, hasn't broken any trends, and that's good. The bottom line here, this is the VIX, the volatility index, and it's staying low. And this it tells us what people are paying for insurance premium to their portfolios for buying options and such. And right now it's staying low, which means that all these internal measures are telling us that this rally still has legs. Sure, anything could come out of the blue and hit us a little bit, but for the time being, sitting on the sideline isn't hasn't been a good play for people. We come here to the interest rates on the 10-year Treasury. And this is going back to, this is 2014 all the way over here on the left. And as we got into the bear market in 22, you see why the interest rates were just going so much higher. And even in 23, they got higher. It got up to 5% on the 10-year Treasury. But in recent months, it is back down, and we're back down here below 4% on the 10-year Treasury, which is very positive for stocks, growth stocks in particular, that are affected by higher interest rates. So perhaps what this is telling us is that the Federal Reserve is done tightening and raising interest rates, and if so, maybe that's a positive for the economy. And all the bad news we're hearing about could have been priced in with the bear market in 22. We don't know. The economy and the markets don't always sync up exactly. And to go to that point, we have here from Trading Economics. I love their website for just data out here. If we look at the GDP growth rate of the last reading is 4.9%. Higher than the previous reading. Those are good numbers for the economy. Could stop later. I couldn't say, but for right now, those are very good numbers, and not seeing a sign of a problem as of yet. Non-farm payrolls. We look at job numbers here. They're increased over 216,000 over the last reading, which is 173. Both positive numbers. We're adding jobs. Unemployment rate 3.7. Not really anything to see here that's a problem. Certainly, people have looked at inflation. A year ago we were having some serious problems with it. It's down in the 3% range now. So I'm not seeing anything there that's really going to kill off the market. And if we go to retail sales, we did have in this set here a negative number at one point, but the last read was positive. So all in all, we could predict what's going to happen with these numbers, and I hear a lot of that on television, but the numbers itself are not showing us as of yet that there's a problem to worry about here. If we come over to the forward estimate of the S&P 500 earnings, and this is all the analysts, they put all their guesses together. I don't want to say guesses, their work together to predict what earnings will be. And as you can see, they're still saying going out to the third quarter of 24, they're still positive. So we're not really seeing anything in the numbers here that would tell us that, oh, wow, we should look out and the market's going lower. Not saying that couldn't certainly happen, but from what I'm seeing here, it's not there as of yet. And then finally, if we come over here to valuation on the stock market, let's say here at the 36.85, that would be maybe a fair value at 20 times earnings on the stock market. We are at certainly a little bit of an overvalued measure, but that does not always equate with a sell-off coming. That can hold for quite a while. I mean, if you look here, you go for a couple of years where it's just well overvalued, that can easily happen. So I point this out just to highlight that the market is a little bit overvalued. So for the time being, if we come back to the big picture from the weekly chart here, positive uptrend, looking like it's going to head through the all-time highs. Daily chart, same thing. Nothing to really see here that's concerning. You'd have to say, and same with the economic data. You'd have to say invested for the time being, and say the market's telling you that everything's fine. So for the moment, that's what we're doing. Put up our contact information here if you'd like to hear information about what we're doing in our portfolios, or have questions you'd like to hear answered in future videos. Please don't hesitate to reach out. Otherwise, hope this was helpful and informative, and we'll see you at the next update. Thank you.